Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investors International Limited. Here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The daily key reversal up made 3 weeks ago, which led to the weekly key reversal up made 3 weeks ago, which in turn ignited the latest move higher, may be running out of bullish incentive. Now the market has made bearish patterns since that original key reversal up, daily bearish pattern since that key reversal up, but yet still maintain the bullish incentive. Indeed, we had a bearish harami as recently as last Friday, which didn't look that aggressive. It is today's action that has prompted some significant soul searching, as we are set to make a possible key reversal down today, a daily key reversal down today. So closing tonight below 242.90, and we'd be on. This all harks back to my comments from last week, and I quote, "So will this rally continue? Well, at the moment, I'm not sure. You see, I could look at the whole July to date action as a type of ascending triangle, but the action looks, well, inelegant. I'd rather rely once again on the two nearby resistances we have above the market, the 2020 high at 241.05 and the November 2011 high at 243.40. The reason is that once those are overcome, well, we have little on top until the October 2011 high at 255.05. I also put down the wide action late last week, so that's 2 weeks ago, to no significant support or resistances between the October 2014 high at 229.15 and the 2012 high. This does go a long way to explain the recent indecision, and that's the end of the quote. You can see from this that whilst the November 2011 high had been breached during most of last week, we only had the one close last Wednesday over it. One close over was never going to be enough. And I quote again, the wide action late last week, that is now 2 weeks ago, to no significant supports or resistances between the October 2014 high at 229.15 and the 2012 high, end of quote, well, that can explain why we had a sharp drop down today, once prices started motoring lower under the 2012 high. We now have, as previously stated, support at 229.15, plus more at 228.40, 225.20, 221.35, 220.10. But I imagine the best will start at the October high at 218 even. London coffee. Since the middle of September until late October, the market had maintained a sideways action between roughly 2100 below and the August 2017 high overhead at 2173. 5 weeks ago, the market took a move higher up to the next congestion at 2279, or what was actually the whole of the 2017 high, where, somewhat surprisingly given the amount of ammunition that had been stored up over that mid-September to late October period, the market ran out of steam and formed a number of highs and tops, peaking 3 weeks ago and again last week. But given that the move up from the 2017 high at 2279 up to as far as the next resistance at 2411 should have been a zone free of restrictions, well, the market had been making a big meal of it trying higher. Then came last week with the bearish dark cloud cover pattern type on Wednesday and a gapping move lower on Thursday, below the middle sign of the optimized late January to late July bullish Andrews pitchfork, currently at 2263. Now, we had been below this middle time before, but this was the first time the market gapped below it, and last Friday's action could not fill in that gap. Today we are even lower, set up for a possible daily key reversal down today. Now, you would imagine that this might be the end of bullish aspirations. Perhaps you might be right. But I would ask you to remember the following points that have still not been touched, despite the strong move lower. Firstly, the rising medium moving average, currently at 2180. You see, I said as long ago as 2 weeks ago the following, and I quote, "You see, I suspect the rising medium moving average puts off further declines because this moving average has been partnering upwards with the August-based uptrend. That uptrend has been since retired since it began, and I think the market knows that to break the uptrend and the rising wedge pattern, this pattern also been retired, you'd also have to break its partner, the medium moving average, and that was just one move lower too much. End of quote. Next, we have the same range between roughly 2100 to 2173 that prices were caught in back in late September and early October. Finally, there is the lower time of the optimized bullish Andrews pitchfork, currently at 2121. This hasn't been touched since its inception in early August, which could mean it is not that fit of a support. However, it is still there and well within the previously mentioned congestion zone between 2100 to 2173. It'll be interesting to see what the market does once it is at the medium moving average. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.